Hey there, everyone. Happy Monday and welcome to the Final Bar. I'm your host, Dave Keller, the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Technical analysis is really not about predicting the future. It's not a crystal ball. Longtime Stockcharts contributor Carl Swenlin used to say it's a windsock, not a crystal ball. It tells you which way the wind is blowing, but you always have to pay attention to the dynamics in individual stocks and ETFs. But if you want to focus on what is happening, on the message the markets are providing back to us in the form of price action, trend, momentum, breadth, sentiment, technical analysis may be the right answer for you. We hope through the Final Bar we're able to illuminate the markets using this fantastic toolkit and also focus on how tools like Stockcharts ideally can help you make better, more informed decisions as an investor. Now, this week has a lot going on. We have the Fed meeting coming up Tuesday and Wednesday. So Wednesday, of course, all eyes most likely on the Fed. Eyes will also be on some pretty decent earnings. We've got the three A's this week. Amazon, AMD, Apple, all reporting Tuesday and Thursday. So we're going to do a segment later in today's show called Yearning for Earnings. We're focused on some of the key stocks reporting earnings this week, what the technical setups are telling us, and what sort of levels and signals to look for as these companies report and we move onward. With that in mind, let's get to our market recap and see how things played out here with a nice late inning surge for the major averages. Before we get to the charts, I want to let you know about a poll we had going recently on our social media accounts. We asked you, rocks, papers, scissors, which asset class performs best over the next 3 months? Rocks, we mean gold there. Paper, referring to paper assets like the S&P 500, and scissors, referring to coupons that are clipped off of your bond certificates in decades past. 43% of you saying stocks, 39% saying gold, so almost a coin flip between those two charts. Very few of you thinking bonds are a decent bet right about now. It's interesting when you think about that relationship between rocks, paper, scissors. This is an exercise we used to do in my Fidelity days all the time, sort of our shorthand of just thinking stocks, bonds, commodities, where might the opportunities be? I would encourage you to follow all three of those closely using the Stockcharts platform. But we've highlighted that strength in gold, but look at what happened here recently. Still kind of holding in there. Crude oil, same thing, holding above $80 a barrel. But stocks over bonds, still a long-term story that remains. Thanks for answering that poll, by the way. And don't forget to follow us on all your social media accounts. We have a Stockcharts account, also a Stockcharts TV account to keep an eye out for as well. Looking at the markets today, I mentioned a late innings surge here. And about an hour ago, here at 3 p.m. Eastern, the S&P actually in the red for the day. The NASDAQ slightly below negative as well. But nice rally in the late innings to get the S&P and the NASDAQ into the positive. The S&P finished today about 1/3% higher off of Friday's close, finishing right around 5116. The NASDAQ composite about the same percentage gain, finishing just below 16,000, and the Dow around 38,387, we'll call it, up about 0.4%. So the Dow the best performer, but not by much. Mid caps and small caps having a little bit of a better day. The S&P small cap 600 just below 1,300 as a level and up about 2/3%. Look at the VIX finally closing below 15. That might be an important data point. As we talked about in last week, and apologies, I was fighting a sinus infection last week, so spotty performance I would grade myself with, and attendance as well, but feeling a lot better today. And as I'm looking at the markets over the weekend, you know, that VIX 15 level is pretty important because for me, VIX below 15 is a low volatility sort of bullish range. That's when a lot of strong bull market phases tend to happen with a very low volatility. That means investors are not anxious, are not having any issues really. It's sort of a slow and steady gaining kind of environment. That's the VIX reading we have right now. Now expect a lot of chop this week with a bunch of earnings. With the Fed meeting, certainly could be some binary outcomes on a lot of key stocks and ETFs, but for now, as of Monday's close, VIX saying sort of thumbs up, conditions are not too bad. Looking at interest rates, you can see the 10-year point coming down. As of Friday's close, we were around 467, we'll call it. We finished today just above 4.6%, around 461, we'll call it. The long bond a little bit further up, around 474. The short end of the curve, of course, is still elevated. You know, as we get to this Fed meeting, and we'll talk about it a lot more tomorrow and Wednesday on the show, but thinking about this Fed announcement, unlikely you would have the first, any sort of rate cut, given the fact that the market is pricing in a first rate cut down the road a little bit. Maybe at the June meeting at the earliest. Certainly, the economic data has been a little stronger than expected, probably throwing some water on that idea that the Fed might be a little more aggressive. So most likely, we're sort of pushing that down a little bit. Generally speaking, since that has come out over the last couple of weeks, 10-year yield has been pushing gently higher. And overall, even though today we pulled back a little bit, rates overall have been trending higher over the last 2 to 3 months. Very much an important thing to think about. And you think about with these earnings calls, how companies are going to be dealing with the prospect of rates being higher for longer, how that might impact their attempts to grow and all of those sorts of things. I would keep an ear open for those particular types of discussions. The dollar about a third lower. This is using the UUP as a proxy for the sort of dollar rate. And if you look at the dollar, 107, if you look at $USD on our platform, which is the main dollar index, 107, kind of a key resistance level we've not broken above. I think if we do, that could be a danger sign, but we're certainly not there yet. Gold and silver moving slightly lower today. The GLD was down about 0.2%, about the same for silver. Copper prices moving higher. You can see crude oil prices down slightly. So overall, kind of mixed, I would say. Gold and silver, generally speaking, probably still in an uptrend. Same for crude oil, but a bit of choppiness here today. Bitcoin continuing to move toward the lower end of that range. We talked about that range from around 60,000 on the lower end, about 74,000 on the upper end. We're sort of at the lower end of there, currently trading around 63,000 for Bitcoin. That's down slightly from the last close. And Ethereum prices just below 3,200. That's down about 2.5%. You can see that the top 10 coins that we track on our platform basically mixed for the day here. Looking at the 11 S&P sectors, you can see the XLY, consumer discretionary, at the top, up 2.3%. Tesla with some really encouraging news out of China. Basically, the Chinese government approving, and I was briefly going through some of these headlines, approving the driverless approach to Tesla, that technology, sort of greenlighting that in China's second biggest market could be good opportunity for growth for Tesla for sure. That is certainly helping pushing the XLY higher. Amazon, the number one weight in the XLY, reporting later this week, which is pretty key as well. Utilities, real estate, number 2 and number 3. Now, what's interesting there, those are super defensive sectors. That is not offense at the top of the list. Besides the XLY, some pretty defensive sectors following things up. Utilities up 1.4% today. Communication services and financials were the only 2 sectors that were down. The XLC, communication services, finished today down 1.2%. Consumer staples, third from the bottom, up about 1/3% for the day here. The market trend model, I would say, sort of mixed at the moment. The S&P as of Friday's close, the short-term model was just barely, I'm talking narrowly, the slightest amount above the zero line. And some times like these, I'm kicking myself for when I, sort of started using this model a couple years ago. I didn't really give a neutral setting. It's binary. It's either thumbs up or thumbs down. But in this sort of environment where we're almost exactly at zero, and it's just a little rounding error that kind of gives the difference, I feel like there should be a neutral rating. If there was, this would be neutral. But in my opinion, I wanted simplicity. So I said thumbs up or thumbs down. Is this model bullish or bearish? So as of Friday's close, the S&P 500's market trend model, my main one, now bullish on all 3 timeframes yet again. Mid caps, small caps, NASDAQ 100, all still negative in the short term, very slightly so. And I think through the remainder of this week, that's something I will certainly be watching by next Friday's close. There are enough gains between the Fed meeting and a lot of pretty decent market cap represented with earnings announcements. Is there enough optimism coming out of those of the announcements and discussions to propel the short-term model back positive? Finally, looking at the Magnificent Seven and Friends, I mentioned Tesla having a pretty solid day, up over 15% today. So a nice recovery after, after being clearly the weakest of these 8 names. Going into a couple weeks ago, Tesla really rebounding off of the lows, up about another 15% today. Still, I would argue a lot to prove before I would classify that as a really good chart, but in the short term, no denying you're seeing some accumulation off of the lows. Apple up 2.5% today, and that is arguably one of the most important charts to watch. They report Thursday after the close. A lot to think about with Apple's earnings, and if the market, if the major benchmarks are to mount an additional gain from here and threaten previous all-time highs, I would argue it's the Apples, Amazons, the AMDs, those types of mega cap names reporting earnings this week really have to surprise to the upside and see additional accumulation through the course of this week. So probably the most important charts to watch in my opinion. By the way, notice today, even with that late stage rally, Alphabet down over 3%, Meta down over 2%, Microsoft down 1%. Now, these are the companies that reported last week, and you're not getting that additional bid you might have hoped for right now. And that might be another set of charts to certainly watch because they're all sort of languishing now after trading lower recently. Let's look at a daily chart of the S&P 500, sort of check in on how things played out. You know, I would say this week, from analysis of the S&P 500, I would say it's all about the 50-day moving average. As of today's close, if you look here, we're sort of gapping right up to the 50-day moving average. Thursday was down here, closed the day right around 50.50. Friday, we gapped higher, traded almost to the 50-day moving average. Today, we finally made it up there, and I would say when you're looking at the S&P below the 50-day versus the S&P above the 50-day, kind of two different looks to the chart, right? And that's one of those basic assessments. One of the breadth indicators that I think is pretty important, which we'll look at in a moment. How many stocks are above their 50-day moving average? Can the S&P get it done? So the bull case from here, I would say the S&P, of course, has to recover above the 50-day. The RSI, the momentum has to improve. Right now, it's just above 50. I would say the RSI needs to power above 60 and even further on a rally, because what that would tell you is there's plenty of accumulation, not just a little rally up to previous resistance, but really some additional accumulation happening through the course of this week. That's when the previous all-time high could very much come in play, and that's the bull case. The bear case from here, maybe the S&P stalls out or at or just above the 50-day moving average. Note that that's what's happening here back in August, September of last year. We had a very similar pullback from an all-time high, or from a significant high. We had a very similar rally up to just above the 50-day moving average in this case, and currently we're kind of trading right around it. Then we stalled out, and what happened was we made a lower high, and the RSI topped out around 60. That is what I might be looking for here, and if you see a similar setup, that's really what a protracted decline kind of looks like right about now. So we're right at that key decision point this week. Can't tell you, I can't stress enough. I think this week is going to be key. And really just a simple assessment. Are we able to get above the 50-day moving average and stay there? The bull case would certainly tell you that's true. I'd like to see momentum improve much more than what we've seen so far. And otherwise, we have a repeat of late August of last year, which ended up being the beginning of much more pain for equities before we finally recovered at the October low. Now, of course, we can roll that sort of analysis up into a breadth indicator. As of today's close, we're almost exactly at 50%. It's currently a coin flip for the 500 members of the S&P 500. Are they above or below the 50-day moving average? It's kind of even between the two. So, again, the bull case from here, I would say, means this indicator gets above 50% and stays there. You have more and more stocks, just like the S&P, recovering and pushing back above the 50. That was, I think, one of the real negative signs that we saw a couple weeks ago was the S&P broke below its 50-day. This indicator broke below 50%, which told you a lot of stocks were breaking down. If the market's going to go higher, you have to have a lot more individual names moving higher as well, which means you need way more new 52-week highs. We need this breadth indicator to move back higher. Now, all of that is arguing over sort of this short-term sentiment. I would also remind you that the long-term measure of breadth that we're showing here, the percent above their 200-day moving average, firmly in the bull case. So I think for now, I'm still labeling this as a sort of pullback corrective phase within a much longer long-term uptrend. This top indicator gets below 50%. That's when it starts to open up the possibility of getting a much more significant drawdown. But I'm not seeing enough danger signs yet to confirm that that's what we're experiencing right about now. So keep an eye on that one as well. All right, let's continue on here, just looking at some of the individual names. Again, we're going to do a segment after the break here talking about earnings and some of the companies reporting over the next couple of days. There's quite a lot of names to follow, to pay attention to, but some of the stocks moving higher or lower on today's session. Tesla, of course, I mentioned the news over the weekend. Again, what a difference a session makes, certainly what a difference a week makes, right? As of last Friday, we're kind of trading down toward 150, down toward 140. Feels like we might retest the January 23 low with the way things were going. But, of course, we gapped higher. And let's see, Wednesday of last week, we had that gap upward above 160. Thursday, Friday, gently pushing higher, but not quite getting above a descending 50-day moving average. So at that point, still looks kind of negative. Today's gap higher gets us back above the 50-day for the first time since early January. We also closed higher, showing additional buyers coming in, going into the close. So overall, all of a sudden becomes kind of an interesting setup. Look at how the RSI is powering above 60. This all of a sudden went from looking like a very questionable chart to a much more encouraging chart. Now, when you have a gap higher like this, as I mentioned before, you want to see the follow through, right? What happens tomorrow? Do you see additional buyers coming in willing to pay more for Tesla? Is this a one-off reaction to the bullish news out of China, or is this the beginning of further accumulation? The only way the price goes higher from here and the momentum improves is if bigger institutions are starting to accumulate shares of Tesla. The price will reflect that by going higher. So keep an eye on Tesla through the course of this week. Bullish setup for now, I would say. Domino's Pizza Group also gapping higher to a new all-time high today. It's up about 5.6%. Once again, back to the overbought region. This was a report before the open, I believe, today. You had a couple names which we'll talk about. DPZ now, again, and again, nice follow through and a nice gap higher, but note the lows going back for the last 6 months, right? Since the October low of last year, we sort of retested it in early November, and then we keep making a pattern of higher lows. And that's what I talk about. When a stock's going higher, you focus on the lows and you see, do we keep making higher lows, right? Are investors buying more on the dips? And that's what the chart looks like when they in fact are. Look at how the RSI never really getting below 40 during this uptrend phase. That shows you that there is better accumulation through this period. So the gap higher on earnings today, just the latest upswing, making another higher high, but after a new higher low in about a week ago, right, in late April. Ben, BEN, is Franklin Resources. This is the firm Franklin Templeton. It's kind of the holding company for that. Again, moving lower quite a bit today on earnings before the open, down over 6%. A number of financial stocks really looked encouraging until they didn't. And I think the problem for Ben from a technical perspective is we had this swing high in mid-January. We then have had a number of failed retests to get above that level. So a clear resistance around $28 a share or so. So this latest breakdown comes after the last failed attempt to get above 28. We then see a breakdown below price support, a breakdown through the 200-day, the dreaded lower high, and now we're making a lower low. So think about DPZ, pattern of higher highs and higher lows, the opposite. Flip that over and you have Ben. You have a stock unable to make new highs, making lower highs and lower lows. The RSI not getting above 60 on rallies. This is the sign of a stock in distribution phase. I'm eyeing that October low around 2150 for BEN. Semiconductors, of course, a key group. On Semiconductor, ON reported before the open today, a nice move higher, about 4%. What's interesting to me is not today's move, but the last couple days, right? If you look at that bounce off of $60 a share, we had a gap higher, I think that was on Wednesday of last week. And then from there, Thursday, Friday, now Monday, you're seeing more and more accumulation. So after a gap, what happens in the days afterwards can be very, very important to see if investors are willing to buy additional shares at this elevated price point, or do they take that gap higher as a great excuse to unload losing positions? And you're seeing the former, you're seeing additional accumulation. Look to see if the RSI can push above 60. That's what stalled out here in February and March as we failed to get above the 200-day moving average. So I still think some more to prove there. Other charts to pay attention to, and we'll get to earnings a little bit later, right? Alphabet gapping higher on Friday, but trading lower, closing lower through the course of the day, following through on the downside today. So stocks like Alphabet, I think, need to push much higher for this market to mount any significant gains beyond what we've seen, right? A bear market rally means stocks like Alphabet gap higher, but then are sold off because investors are still going risk on. If investors are putting risk on and they're thrilled to buy Alphabet, even at an elevated price level, we would see additional appreciation. That would help the benchmarks move higher. You're not seeing that right now on the chart of Alphabet. You're certainly not seeing that on the chart of Meta, which gapped lower and now has started rotating still within the range of that gap day. Microsoft is another one, right? So these are three companies that reported last week, and all of them sort of rotating lower, right? So Microsoft actually breaking below its 50-day moving average mid-April. Last week, trading up to a declining 50-day moving average and failing to get above there. So while that breadth indicator we looked at earlier, the percent of stocks above their 50-day moving average, is kind of aggregating Microsoft and 499 other S&P members, are they above or below the 50-day? But remember, many of those individual stocks also have a bit of a story behind them as well. And I would say keep an eye on Microsoft. For now, if you ask me to pick a direction up or down, I would say down by the fact that we've had bearish divergences. We're now breaking through the 50-day. The 50-day is now sloping downwards. We're unable to get above there. The RSI is below 50. The relative strength threatening to break down. That's more going down than going up as I'm looking at that particular chart. So Alphabet, Meta, Microsoft, I would argue, really have to start to rotate higher to provide additional upside. If our benchmarks are going to retest all-time highs, those three names, I think in particular, most likely have to go up. That is it for our market recap, touching on some of the key charts to reflect on today. Again, this week, a lot going on with earnings, but especially with the Fed meeting Tuesday, Wednesday, so we'll have a lot more coverage of that and some of the bigger implications for interest rates and other risk assets. A couple quick announcements before we get to our next segment, yearning for earnings. First off, we love to hear from you. We appreciate all of your thoughtful feedback, comments about your host, our guests, the way we're doing the show as we make some changes to Stockcharts TV. I do want to remind you, our mailbag is always looking for some more questions. We're actually planning to do an all mailbag episode on Friday of this week. We'd love to answer one of your questions on our show. We had a great show on Friday, by the way, hitting some of the comments in the mailbag. Can't thank you enough for all those great questions. We'll do one this Friday as well. Email is always best, thefinalbar@stockcharts.com. We'll look for your questions, of course, here on YouTube. You can just drop them right below the show in the comments section. As a reminder, I will be traveling to Silicon Valley next week, May 7th through 9th, to speak at the Investment Masters Symposium. Money Show has done a great job with these sort of smaller, more intimate events. Did one or two of them last year and really enjoyed it. So I'm excited to go down there. We're doing a workshop. I actually found out there's a meet and greet with me the one evening. So, boy, if you come, please make sure you go to that so I'm not lonely sitting at a meet and greet all by myself. So I hope to meet you there. Please come by and say hi. And I'll be doing a 2-hour masterclass, I think on Wednesday of next week, called 7 Questions to Ask Before Every Trade. I'll actually share with you the checklist that I use as a technical analyst. We'll go through some examples together, take some tickers from all of you, and have a great couple hours together learning about the rigid, more systematic, more disciplined way of analyzing the markets using technical analysis. You can sign the QR code or scan the QR code on your screen to sign up for that event coming up next week. Also, Stockcharts is doing a rare mid-year sale in celebration of 25 years of being Stockcharts.com. We're happy to offer you a fantastic sale on our Stockcharts paid memberships. The really good stuff like scanning, alerts, customization, managing chart lists, sharing and sending, all of those things are really super powered as a Stockcharts member. Also, our ACP platform, access to all the plugins, some great premium events, all available to Stockcharts members. You can scan the QR code on your screen or go to stockcharts.com/special to find all the information and how we can help you become a premium member. It is super easy to do. And by the way, if you're a current member, you get an even better deal. So make sure you go there. It's a perfect time to extend your membership a little bit further, and we'll look forward to navigating this market with you in the coming months and years. Let's continue on with our next segment, Yearning for Earnings. We're in the midst of earnings season, really in the meat of it. Last week, we had a lot of big names reporting, and of course, some of them, as I just highlighted, continuing to not necessarily impress from a technical perspective. Let's talk about some of the names that are reporting over the next couple sessions. Think about what the technical setups are, but focus on key levels to keep in mind going forward. We're going to start here with PayPal, and I think PayPal reporting before the open tomorrow. That's on Tuesday's session. Now, when I think about this market, and when I think about example charts to share with you, PayPal kind of stands out to me because as far as I can tell, I would argue this is in the process of an incredible rotation from a distribution phase through 2023, really started in 2022, and then an accumulation phase really coming off of the October low from last year. And what I mean is this, right? We have a 200-day moving average that has been sloping downwards. We had a number of failed attempts to get above the 200-day. Look at how many times from 2022 to 2023 that PayPal either traded right up to a declining 200-day moving average, maybe briefly gapped higher before failing, or traded above it and closed above it for a couple sessions before going back lower. The 200-day moving average has served as great resistance for this chart up until the last couple months, and you can see an initial or a latest attempt to get above in January failed, another retest in February, and then mid-March comes and we finally get above the 200-day. But what happened after that, I think, is what's maybe most encouraging. We've now found support at the 200-day moving average. So resistance has now become support. Look at how the momentum has shifted from more of a bearish range with the RSI often below 50 to more of a bullish range with the RSI sort of ranging between 40 and 70. This is more kind of consistent with bullish phases than bearish phases. So after the October low, the chart of PayPal, right, sort of on, November on versus to the left previous to November, looks like two different charts almost, right? And I think from here, you're starting to see higher lows, especially the low in February, the low in mid-April. Now we're arguably starting to see a new swing high. And when I look at the January high around 67, 68, you look at the late March high, the early April high, and where we finished the day today, kind of right around that label. PayPal is really close, around that level. PayPal is very, very close to breaking out to a new 3-month high, actually more of like an 8-month high, with potential to, I think, certainly go much further if we're able to get above that $67 level first. So I think we're right at that crucial level of resistance. We'll see through this week, particularly with earnings before the open tomorrow, if there's a positive result, I think we power above that resistance. And I would argue if that happens, this certainly is finally completing this rotation, which has been in the works for the last 6 to 12 months. We have a disappointing quarter. This becomes even more of an important resistance level, once again validated. And by my read, that's still probably a bearish chart until we can get back above that level. So PayPal with a very clear line in the sand going into tomorrow's report. And again, keep an eye before the open and see if we're able to hold that level, I would argue, into the close tomorrow. Amazon is another one. And we talked a lot about these sort of air quotes magnificent 7 names over the, really for months and months now. But particularly now because we have a meat of them, most of them reporting earnings last week into this week. Amazon is one of those companies reporting tomorrow after the close. So PayPal's pre-market, I believe Amazon and AMD are after the close tomorrow. These are two really interesting charts. Amazon, of course, is the biggest name in consumer discretionary. The XLY doing quite well today because of Tesla's positive news. Do we sort of continue that trend of strength for consumer discretionary with Amazon having a positive result? Now, from a technical perspective, I would say over the last week, we are teasing that 50-day moving average. We've kind of traded above and below it for quite some time. Look at the momentum, which arguably is still very much in the bullish range, right? When a market is going up, when a price is going higher, the RSI tends to be overbought on rallies like you saw in early February and early April. When we pull back, which will happen, you often will find support at the 50-day moving average. You will usually see the RSI bottom out around 40. And as long as it holds 40 on a pullback, that's one of those data points that tells me, okay, generally speaking, this is a stock still in an uptrend. Even last week, we gapped lower for a day, but closed back toward the highs of the day, indicating that just in that short-term window on that one day, we saw traders buying in on weakness during the trading day. So overall, I would say the general setup here is still quite constructive. If we would get a negative result, I think keeping an eye on the low from last week is important. Keeping an eye on the RSI probably more important, right? Do we hold an RSI of 40? Because if so, it's still probably okay. Excuse me. If we do break below RSI 40, that would be a very dangerous setup because it would tell you the momentum is really starting to wane and you're starting to see more distribution than you probably want. If we do have a decent report, I'd be looking to the left at 190. That's the resistance from early April. Can we get above there? I think the bull case for the S&P, the NASDAQ 100 involves stocks like Amazon getting above 190 and holding it, right? You need these big mega cap names participating in the uptrend. So a lot to prove, I think, for tomorrow's report. AMD, of course, in the semiconductor group, you can see quite a deterioration from early March to where we bottomed out about a week and a half ago here in mid-April. From there, we're popping higher. We finished day around 160. It wasn't a bad day, up about 1.8%. But I think going into tomorrow's report, from a technical perspective, we're sort of in that limbo between two moving averages. So we've broken the 50-day. And again, think about what that means. In the short term, we're sort of trading below that initial threshold, right? Look back here in June and July of last year where things still looked okay. Even though Amazon had pulled back a little bit, we were holding an ascending 50-day moving average. When that stopped happening, all of a sudden it feels like, okay, this is more of a protracted decline, or certainly an elevated risk of that. Same thing here. We've now broken decisively through the 50-day moving average, but we're holding the 200-day, and stocks holding the 200-day moving average is still okay from a long-term sort of time frame. So I would say there is some bearish technical evidence. We did not hold the 50-day moving average. The RSI actually blew way below 40 and is still currently around 45. That's not particularly good. Bull case from here means we have to get above the 50-day moving average. But what if we break below the 200-day? I think a very negative outcome from this coming week, thinking through Tuesday's session with AMD reporting, thinking through the Fed on Wednesday, if those are not as encouraging signs that we get from those announcements, AMD below its 200-day is a pretty frustrating chart, and certainly coming a long way from making a new high just about a month and a half ago, 2 months ago, we'll call it now, in early March. So I think the 200-day, the 50-day, those are the two levels I would probably set an alert to see which one of those comes first. At some point, we break above the 50 and or below the 200-day moving average. I think that break could tell us a lot about the next leg for AMD and could have implications for semiconductors as a whole. Through the remainder of this week, just to hit on a couple more before we wrap this segment, yearning for earnings. On Wednesday, before the open, two names, both starting with the same letters here, MA and MAR. That's Mastercard in the financial sector and Marriott in consumer discretionary, obviously part of that travel and tourism theme. Now, Mastercard and I think DraftKings, which is another one Thursday after, both of these two charts are important to watch because I think they're representative of what has happened to this market. Particularly when you look at Mastercard, which is this chart here. Mastercard February into March featured that bearish momentum divergence. It's a very negative setup where you have the market going higher on weaker momentum. And I remember doing a webcast in mid-March, and it was something about a bull market checklist, which was basically our market top checklist, because one of the things I'd observed were a bunch of these bearish divergences. And when I look at the chart of Mastercard, one of the things that tells me we're probably not done yet with the market decline that we observed up through last week was the fact that charts like Mastercard are really giving pretty serious topping signals here, right? Higher highs February to March on much weaker momentum. Look at the RSI in early February, the RSI in late March. I mean, two very different reads as Mastercard's still making new highs. From there, we made a new swing low. We undercut the 50-day moving average, failed to get above it after testing it from below. That's right around 470, the 50-day. Now the RSI well below 50, the relative strength making a new 3-month low today. So, not knowing anything else about any other charts, I would say the chart of Mastercard is not particularly strong, particularly in the short term. It's suggesting weakness over strength. So Wednesday before the open, a positive earnings release could change that, but I would say the technical setup going into earnings is not particularly strong at the moment. Jumping to DraftKings, which is Thursday after the close, I believe, we have a similar kind of look. It wasn't as exaggerated of a bearish momentum divergence, but still there with the March high coming on weaker momentum. From there, we can see, again, a break below the 50-day, and now we're retesting it from below. What's interesting about the chart of DKNG, by the way, is we had a bunch of these sort of brief breakdowns below the 50-day moving average. But look at how in each of these last couple times, we had a gap higher above the 50-day, and that was sort of the all-clear sign. Here we had a gap higher. You could probably call that an island reversal, which was a gap lower, a bunch of action, and then another gap higher, sort of continuing to the upside. Now we've traded below the 50-day. Do we get that gap maybe on earnings this week? Then that could be a really encouraging sign suggesting we're on our way to a new highs. I would say DraftKings is setting up okay in that the momentum is still decent, but we are below the 50-day moving average. We actually went back below it today going into the close. Apple is the final one I want to share with you. And again, sort of going on this mega cap theme of names to watch this week. We talked about Amazon and AMD on Tuesday's session. Apple is Thursday after the close. Excuse me, today gapping higher, but closing back at the lows of the day. You might label this, let's look at a candle chart. You might label this a gravestone doji. At the very least, you'd call it a shooting star candle. So when a stock gaps above the 50-day moving average, that on its own is kind of encouraging. But when that gap results in a brief rally, but then a close back at the lows, that's called a shooting star candle. That tells you in the short term there's actually distribution as opposed to accumulation. So not a particular good look for Apple. Keep an eye on this one with earnings. We've got to get back above the 50-day, maybe put in some sort of higher low. Until then, I would say the short-term picture on Apple still kind of questionable. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close. A lot coming up this week with earnings, with the Fed, so make sure you tune in every day. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night. Rock, paper, scissors, shoot. Oh, rock, paper, scissors, shoot. Oh.
Okay.
Rock, paper, scissors, shoot. Rock, paper, scissors, shoot. Rock, paper, scissors, shoot. Boom.